All right, welcome to Claims Hero, the podcast. Today we are joined by George Hain, who is a claims executive at Claims Hero.
Thank you, Luke. Thank you for having me. It's a pleasure to be here.
Perfect. Today we are doing the exciting topic of insurance policy benefits for home claims. So what that means is you have an event, you'll have damage sustained at your home, and today what we're talking about are some of the things that you can claim from your insurer if your property does suffer damage. But also then, what are some of the challenges that come up? How can you overcome those? And what evidence you can give to assist in that process? When we talk about policy benefits, that refers to the product disclosure statement. So when you take out an insurance policy, there are certain benefits that you get as standard. And then there are also some optional policy benefits that you get as well. A lot of people do not realize that not all policies are built the same and not all insurers act the same way as well. So what policy you have can really impact what you're entitled to when it comes to claims time. Even the standard policy benefits that you get may vary across insurers. Unfortunately, a lot of people only find that out when they make a claim. The other key part of that is the amount of cover that you select. So what are your sum insured limits, which appear on your certificate of insurance, which will get sent to you when you take out the policy. Again, we do find that people are chronically underinsured, which is a tough thing to find out when it gets to claims time, and you may be out of pocket. So some of the standard benefits that we will discuss today are things like the cost to rebuild your home. Sounds so simple, but there are some complexities that come into that. Temporary accommodation, so if your home is not safe to live in, where do you go and move to? Where do your family go to move to during that period? And then some other coverage that will arise to different levels in different policies, some of which are optional, include things like contents damage, pet accommodation, professional fees, temper com for pets, replacement of lock and keys, professional fees, and the list goes on. So we'll cover some of those today. But the key is really about helping people navigate when you have a policy and you have damage, what can you claim? Because there's one person who often will not tell you what you can claim, and that is the insurer, unfortunately. So for people, they need to be educated when they go into a claim so they can make sure that they're putting forward the evidence they need to justify those claims. So we'll start with the most obvious policy benefit, which is building damage. So we're not going to go into detail because we spoke about this in other ones, but if we assume you've got a storm or you've got a flood, that's obviously going to cause significant damage to your property. One of the things that's really important to know up front around building damage is that it is a new for old policy. So what that means is that under most domestic insurance policies, if you have a kitchen that is damaged and it can't be repaired, the insurer will replace that for a like-for-like replacement of that kitchen. They're not going to try and necessarily put back the old one, and you can't go out and buy a second-hand kitchen. And the main reason for that is because it actually makes insurance a lot easier. When it comes to commercial property, there's a lot of depreciation and things that needs to be worked out. And if it really wasn't new for old, people would be finding themselves significantly out of pocket when a claim happened. You can imagine if you had a kitchen that's worth 40 grand, but because it's 10 years old, suddenly it's depreciated to half its value and you only get paid half of that, you wouldn't be able to afford to put your kitchen back. So the first thing to remember is that it is that new for old. So once something is damaged and it needs to be replaced, it is new for old. So as a general rule, George, if I have property damage cover on my insurance policy, what does that tend to cover in terms of things within your property?
Yeah, look, in most cases, it covers fixtures, so things that form part of the structure of the home. So that tends to include flooring, ceilings, built-in kitchens, cabinetry, bathrooms, or any other item that are permanently attached to the property. A useful rule of thumb is that something that would normally stay within the house, if you sold it, it's usually treated as part of the building and covered under property damage. By contrast, loose or movable items like furniture, non-fixed appliances, they typically fall under contents cover.
Yeah, I think a good way to think about it is it's basically everything that is screwed down to the property. So if you could hypothetically pick the property up, turn it upside down and shake it, anything that stays within the property is a fixture and therefore covered under the building component. And we will get to contents, but contents is basically everything that falls out at that point. So all of your personal valuables falls within the contents aspect, but everything that is secured within the property is covered under building damage. So what people need to understand when it comes to building damage is that it is not just the replacement of it, but your sum insured includes the removal of those items. So a flood is a good example where you see this and a property is significantly damaged. The people that come in straight afterwards and they start stripping out the plasterboard that's been covered in this flood water, all of those costs also form part of usually the building repair cost. So if you have a sum insured of $300,000, that includes often the cost to restore it and to remediate it, and then also to rebuild it as well. So if things are happening to those fixtures within the property, your building damage cover is arguably responding at that point. If I have building damage and I contact my insurer, what's the normal process that will happen in terms of how are they going to assess the damage at my property?
So once you report building damage to your insurer, the first thing they'll check is whether the policy covers what's happened. So that means they'll look at the cause of the damage, when it occurred, and what the cause is insured under the policy. For example, storm, fire, impact, or water damage. If the policy does respond, the insurer will then usually arrange to assess the damage themselves. They might send out a builder. For a larger or more complex claim, that might also involve a loss adjuster. And their job is really just to confirm what's been damaged and what work is needed to repair it. From there, the insurer then uses the assessment to decide the next step, whether repairs are approved, further experts are needed, or quotes are prepared.
Yeah, so you would think that all insurers do it the same way, but they actually don't. What we learn is different insurers have different models, so how they respond varies across that. But as a general rule, they're trying to assess the damage. They're trying to understand, well, what has happened to this property and does the policy cover that damage? So the way it varies is that some insurers will have their own internal assessors who go out to the property. So they'll be wearing a shirt that has the brand of the insurer on it. And other suppliers will rely on their provider panel, or they might appoint a loss adjuster to come out and assess it. And that's why that process varies across different insurers and why customers need to be aware that they should prepare for that, because a lot of people just have their assessor turn up and they're like, oh yeah, my property suffered damage, unlock the door and let them in. But they really need to take control of walking the person around their property, showing them the damage so that they can document that, and the insurer can ultimately make a decision on whether or not they're going to cover the damage. As a general rule, if it's a flood and you've got flood cover, it's probably not going to be overly controversial. Where the problems start to arise is when they're starting to quantify how much is it going to cost to fix this damage. And it's important at that point that the building repair benefit is not just the dollar value of it. For most insurers, you can also elect to get them to do the repairs. So that is, the builder goes out, does a scope of works, insurer says, yes, we're going to cover this damage. The builder, who's been appointed, may then actually undertake the repairs for the person. In circumstances where they do that, the builder will take care of everything and they'll project manage it through that process. That's a very oversimplified version of it because there's a lot of problems that can arise. The other option is that you get a cash settlement for the repairs. If the insurer is electing to cash settle or the builder is electing to cash settle, what are some of the triggers for the insurer where they might decide they want to cash settle the claim?
Insurers will usually move to a cash settlement because of risk, not convenience. So a common trigger is when there are maintenance issues or pre-existing defects at the property. And if there are parts of the building that weren't properly maintained, or there are underlying problems unrelated to the insured event, then insurers are often reluctant to manage the repair themselves. Now, that's because when an insurer does organise the repairs, they're effectively standing behind the works themselves, and they're expected to warrant or guarantee those repairs. If there are any underlying issues that they can't control and they can't confidently do that, and in those cases, they'll often pay for a cash settlement instead and leave those repairs to the insured.
So what you're getting at is the insurer offers a lifetime guarantee on the repairs. So that means if their builder does actually undertake the works, they'll give a lifetime guarantee on repairs. Well, some of them do because they're all starting to change their wording slightly around that. But it means that if any issues arise as a result of those building repairs, they'll come back out and fix it at that point. So when they're saying they can't warrant the repairs, why is that often the case in terms of their builders looking at a certain aspect of this claim and going, if I was to do those repairs, I wouldn't be able to warrant it? What are they actually saying in practical terms?
So usually that would arise when the policyholder has a defect or a pre-existing issue. So ultimately they can't provide that lifetime guarantee. So it's a matter for the policyholder to attend to those issues. For example, if there was a pre-existing issue on the roof, but they've accepted liability internally from a weather event, then they can't warrant the repairs.
So yes, you're right. It just means they can't warrant the repairs. So there's some maintenance or pre-existing issue, which they usually want the homeowner to fix, and they may do the repairs. I think what's important to know is that some insurers take that to the extreme, and they'll be raising maintenance issues or good condition issues that they call it, which means that someone's property will never be in good enough condition for them to undertake the repairs. And sometimes we see that insurers are actually pushing some issues that may be claimable damage into maintenance issues. So customers just, they shouldn't just accept that. If the insurer is raising it, they should be looking at, well, what are those maintenance issues that they're raising? And are they true maintenance issues? Are they true pre-existing issues? Or should they be challenging the insurer about coverage and, ensuring that the repairs are actually undertaken and including those items? One of the other things that we see in that process is a lot of the large national panels sign up with all the insurers and say, yes, we can service all of your customers. Don't worry about it. We've got so many people. Then you have a large natural disaster happen. And then what we see is the industry comes under pressure, particularly those large panel builders. And what happens is, in practice, is they'll go out to people's homes, and because they've got so much work on, instead of saying to the insurer, hey, we may have overcommitted here and we actually can't repair these properties, they become far more focused and obsessed on maintenance issues, because then they can say to the insurer, oh, we can't warrant the repairs and therefore we want a cash settlement. So we do see with some insurers in particular that there is a spike in cash settlement offers after a natural disaster, and part of that is driven by these large national builders. The reason why that's quite a bad process is that they are often raising things that aren't maintenance issues. So there's no Australian code or regulation that requires someone to undertake that work, or they're saying that it's non-compliant with codes that didn't apply when they built the property. So it would be unreasonable for an insurer to expect that a property complies with codes prior to when it was built, because they know when it was built and they take it out. It's really quite a corrupt process that can result in consumers spending thousands of dollars on things that didn't need to actually happen. So I think it's really important, if that is happening to a customer, that they seek a second opinion around whether or not they are maintenance issues or if they need to be fixed. Importantly, however, when an insurer elects to cash settle, they are then required to pay a customer what it would cost them to get the repairs done, not what it would cost the insurer to get it done, because obviously they have national panels and they have guaranteed amounts of work they may give them, and they have the lowest rates in the market. I wish I could get the rates that their contractors charge them. I would probably have a lot of things done at my own home. But what we do see is that they tend to push that dollar value on a customer and go, here you go, here's $5,000, go rebuild half of your home. For consumers that may find themselves in that situation where the insurer is electing to cash settle, they've got an offer from the insurer that is low. What are some of the steps they might be able to take to try and demonstrate to the insurer that the offer that they're making them is not sufficient for the repairs?
So first and foremost, I would usually recommend that they commission a further quote to really provide comparative evidence to that initial quote from the insurer. They can either complain, whether that's through an RDR complaint, for that to be escalated through to the external team from the insurer. We tend to see that they tend to affirm the original position or decision from the insurer, but ultimately they can also pursue AFCA. They've got strong evidence to say that, their quote should be accepted.
Yeah, I think that's right. One of the first things to do is also to understand, well, what is the issue here? If you think your kitchen is worth double that, what is the insurer saying and why have they formed their view? Sometimes we do see it's because the builders will put in their quote a provisional sum, which basically just means the builder's best guess. And we do see that these quotes can take 15 minutes for a builder to do, even for a large loss one. So they're running through and they're doing this super quickly. So I think it's really important as a customer to document what you think is missing from that quote as well, because it's important for two reasons. One, you can go back to the insurer and say, hey, you forgot all of these items, or these are incorrect. But to your point, you can also get your own quote from an independent builder, because when we say it has to be what it would cost you to get the works done, well, the only way you really know that is if you can find a provider in your area to get the works done. The other thing that we know is after a natural disaster, what happens to the price of everything? It goes through the roof, not necessarily for insurers because they probably have agreed rates with their providers. So getting a quote from someone who's actually willing to do the work, make sure that you're really clear to them that it does have to be like for like. So it needs to put it back the exact way that it was. Sometimes when you've had large loss, people decide they want to make some changes to their property, and that's completely fine, but the insurers are only liable for a like-for-like replacement. So putting it back exactly the way it was. The exception to that can be sometimes when you have something damaged, it may require it to be changed to meet current codes, for example, current building codes. So you may have a roof that becomes damaged, it needs to be replaced, but the way your trusses were designed when your roof went on 50 years ago is no longer compliant. Most of the policies will actually cover the upgrade costs to get your house to then be compliant, as long as it's directly related to the damage and the repairs that the insurer is warranting. So it may be in that scenario that you need a quote, but you may also need some expert evidence from, say, an engineer to understand, well, what is required to get it up to current standards. I think it's really important when you're engaging to get that quote that you try to get whoever you engage to try and match a similar scope of works to the insurer. So what I mean by that is obviously if they've included items, then including those similar items, but also structuring it the same way. So we do know when we get our local builder around, they'll often go room 1, 20,000. But what the insurer needs to see is, well, what are the measurements for the plasterboard? How much painting is required? How much skirting? How much architraves? And really broken down line by line so that the insurer can then validate that, yes, that is what was there. That is what's required to put this home back together. To your point, even when you do the right thing, the insurer will often get your quote and go, that's excessive. And they don't tend to provide anything other than that to say, oh no, that's excessive. And what I always say to the industry is that yes, it is excessive if the only thing you're comparing it to is the rates that you get. But most customers aren't a multi-billion-dollar insurer, nor do they give billions of dollars of work to builders. So that is really a red flag for you if an insurer is saying that your quote is excessive. And then that is probably that trigger to push that to the complaints process, as you said, or also go to the Australian Financial Complaints Authority with your quote. The only other topic I sort of want to touch on, and I appreciate the last podcast was completely about mould. If you do have a claim that involves water, which to be fair is a lot of the claims that insurers receive, mould can become a big problem. So if I'm a customer and I have a claim that involves water, what are some of the things I should be thinking about?
Yeah, look, so with water claims, timing is critical and it's important to engage the insurer early. The first thing to think about is make safe works. So making sure the insurer takes steps to stop the water source and prevent further damage as soon as possible. You also need to be mindful of water damaged materials. So items like plasterboard, insulation, flooring often need to be removed, not just left in place to dry. Proper drying is also another key issue. So insurers should really be arranging professional drying with the right equipment and moisture testing, rather than relying on air drying. And finally, it's pretty important to raise mould concerns with the insurer early on. Even if there is no visible mould yet, water damage creates the conditions for it and it's much harder to deal with once it develops. So essentially, it's really about making sure the insurer acts early, whether it be make safe, proper drying and managing mould risk from the outset.
I think it's a really important point, and often forgotten in this, is that your insurer should be doing a make safe on the property. And really all that means is that often if you've got an event, something's let water in, it could be causing further damage. It's about mitigating the further damage beyond what's just happened to your property. And that will vary depending on the type of claim you might have, because if it's a flood, it's probably cutting out the damaged materials, it's putting fans and blowers and drying out the property. Because if you do that, it'll stop the mould from growing. Often we do see that the insurers are very quick to go, oh, that's a maintenance issue on your roof, even though you're sitting there going, well, I've had many storms and water's never been coming into my lounge room before, and now every time it rains, it comes through. But these builders with a straight face will say that that's maintenance issues. But what the insurers forget to do is put the tarp on the roof and stop the water coming in, irrespective of whether they're going to be ultimately liable for that roof. So I think if you do find yourself in that situation where you're like, this is getting worse, the damage is getting worse, you should be thinking make safe, asking the insurer for a make safe, using that terminology because they will understand what you're asking for, but then also being quite clear with them. If you want a tarp on your roof, or if you want them to cut out the damaged materials, just making sure that you're really explicit with that request. Ultimately, what we see a little bit when water's involved is mould, and the correct specialty that should be coming out is a restorer to remediate that mould, to dry out the property, to cut out the damaged materials, because if you do all of that within 4 days, mould can't grow. But in a normal claims process and in the insurer's defense after a flood and they're under pressure, they sometimes can't get out quick enough. So it is important in that scenario to make sure that you are reaching out to the insurer, saying you're concerned about mould, requesting a make safe and putting all of that in writing, because you can always rely on that later on, because we will talk a little bit later on about what happens when the insurer's conduct may have contributed to the damage of your property and how does that impact what you're entitled to. All right, so obviously once they've come out, they've assessed it, they've sent people out, they've made cash settlements. The other thing that comes up a lot is exclusions. So that's where the insurer is trying to limit their liability or not pay a policy benefit for a particular reason. Some of the ones that come up quite a lot are around, say, maintenance issues or pre-existing defects, which is where they're saying, well, we shouldn't be liable for something because it was already damaged prior to the event. I think what's really important when you talk about that exclusion in particular is that you have to understand the onus of each party in this process. So a customer needs to prove that an event happened and the damage was sustained, and then an insurer needs to prove that an exclusion applies without relying on assumptions. Because what happens a lot, if I use the mould example, is someone comes out and they go, oh, this mould's environmental, it's not related to the event. And what they've done is two things. They've made an assumption that it's related to something that was pre-existing, or they're making an assumption it's not related to the event. And they're also forgetting to do scientific testing, which could conclude that. So if they are relying on one of those exclusions, they must prove it. So if they're saying it's pre-existing, they need to have actual evidence to show that it's pre-existing, and make sure that if they are relying on an assumption, they're making that really clear. Because often they will send out the wrong specialist who will comment on something that they shouldn't, and then they will rely on that. They'll deny the claim and say, oh, this is pre-existing, it's not covered, it's unrelated. And it's later on when you get into that AFCA process, it becomes very relevant around, are they relying on an exclusion, and was there an assumption in that, which I find happens way too often. Some of the other ones is that people aren't fully aware of what their policy covers. So retaining walls, for example, is a good one, where most domestic insurance policies do not cover retaining walls. If you have an event, even though the event is covered, it damages your retaining wall, the policy doesn't cover damage to retaining walls. Insurers are very quick to decline it. So the same goes for pools. And a lot of policies, if they do cover pools, it's a very limited policy term. So the one that I always sort of laugh at, because I have no idea what they're trying to say, but they say we cover pools, but we don't cover damage caused by water escaping from, running down the side of, or getting underneath a pool. Now, anyone who's had pool damage is always going to be somewhat related to water or a storm or a flood, and the pool's going to pop out, it's going to damage, it's going to crack. But even when I've said to the insurers at times, what does that even mean? Are you trying to just not cover water that's in the pool so the water escapes? And half the time they don't even know, but they'll just start using these exclusions when claims happen. So it's really important to understand exactly what's covered, and then ensure that they've actually proven that has occurred on the claim. So for people who have retaining walls and pools, make sure you read your policy, because they're extremely expensive items in your property and you want to have cover for those. And it's a really harsh reality some people find themselves in when you have a claim and that's not covered. One of the other ones is, and I always find this kind of ironic, that we have an insurance policy that's meant to cover events that are likely to happen at your property, but most domestic insurance policies don't cover water escaping from the shower base in your property. So for context, where you're most likely to get a leak in your property is the shower base. If water escapes from that and it causes damage to your property, a lot of policies will say that we don't cover any of the damage associated with that water escaping from the shower base. So you'll have the insurers sending leak detection people out to try and prove that the leak might be coming from your shower base. And then as soon as they find it, they sort of pack up their tools and go, woohoo, we've declined another claim. But the reality is you also need to make sure that they're actually establishing that it is related. So one of the common things that they do is they send a plumber out and he blocks the plug hole and he does what's called flood tests, where they basically fill up your shower base with water, which I also think is funny because not many people sit in their shower and block their plug hole. But anyway, apparently this is a great test. And then once that water starts filling up, it'll start leaking because there might be some waterproofing issue. And then they'll say, oh, there you go, the shower base is leaking, therefore it's excluded under the policy. But when you look at it, you can actually see that, well, there's water damage from midway up the shower. So they will sometimes find other leaks when they're actually looking for one that may be covered. But I think what's really important to understand is that people who go out to find these things are sometimes not being paid much money to be there. So they're trying to do it as quick as possible. So again, just because they find a leak doesn't mean it's the leak that's causing the damage. So when it comes to shower base leaks, just really think a lot about, is it the taps that are leaking? Is it the spindles that might be leaking? Is it something behind that? Is the water coming from higher than the shower itself? It could be a roof that might be leaking, and don't just accept what the insurer is saying. So you might need to get other expert advice. Is there an example that comes to mind for a claim that you've seen that relates to this idea around policy exclusions?
Yeah, look, I have. I mean, ultimately, it's quite a common theme. Some insurers tend to rely on the poor workmanship defects to preclude themselves from coverage positions on a particular claim. I mean, by way of example, I had a matter down in Victoria where there was a large storm that rolled through and there was a chimney that came down, and then ultimately that caused some internal damage. And then the insurer commissioned an engineering report and indicated that the building hadn't complied with the current Australian standards, but noting that the fact that the building was built over 60 years ago, and arguably they relied upon that to say that that gives rise to the exclusion clause, which, you know, in turn precludes cover for the policyholder. But really, the big issue in that case is that the proximate cause, I mean, at least from our point of view, is that it was a windy day, it was wind gusts of over 140 kilometres or knots, and then ultimately it's fair to say that that is event related. So realistically, that should be covered. And also noting that if they are going to rely on that precedence to say that, you know, all buildings don't comply with the current Australian standards, then really that is a risk for the insurer, because then they would have to review all of the current vintage properties to ensure that they currently meet those standards to ensure that coverage is met.
Yeah, I think that's true. And we see that a lot with engineers. It's kind of when the insurers think it's hard, they appoint an engineer, but it doesn't mean that an engineer is the correct specialty to sometimes be commenting on things. Yeah, the one that comes to mind for me is like an insurer sent out an engineer after a fire, and this fire had caused significant damage. And this engineer went out, did an assessment, basically concluded that prior to the fire, the property wasn't in good condition. And the insurer then used that to then rely on a policy term. Well, actually not, to basically go back to a misrep argument to say, well, had we have known that, we wouldn't have offered you a policy. So they try to rescind the policy and say, sorry, you don't have a claim because you didn't tell us about the condition of your property prior to that. And I think my point around proving it is like, one, could I please have access to the time machine the engineer used? Because that would be really great. I think we could use it for better purposes than attending insurance properties and going back in time, because the reality is he wouldn't have been able to know because the fire had caused extensive damage. He'd made a number of assumptions to get us to the point of which he thought it was poorly maintained prior to that point. So if an insurer does that, it's the same thing that we said previously. Think about independent expert evidence and then showing and arguing to AFCA that, well, look, they've relied on assumptions to try and get up an exclusion, and probably just ensure that you are working with AFCA, because, I mean, really after that point, insurers shouldn't be able to just keep sending out experts, because they should have and are required to have sufficient evidence at the time of declining the claim. But far too often we see that they're quick to decline, and then when they get challenged on it, they realise they don't have sufficient evidence. And instead of overturning the decision or saying, sorry, we didn't have sufficient evidence and we declined that, they'll make a whole heap of reasons to try and go out and do another assessment to help you, George, understand the problem here, where reality it's just shoring up their evidence. Also, just because an engineer says it doesn't make it true. If I had $1 for every time I've proven that recently, I think consumers just need to keep that in mind and to feel comfortable to challenge it. Even if you don't have another expert advice, just showing why objectively it can't be true what they've said. Like the ones that happen after the flood all the time is engineers go out and say, oh no, yes, there's been structural movement to this property, but that's just long-term water pooling, which means that there's a little bit of lower level under the ground, and when it rains, a little bit of water goes in and pools there, and they think that then obviously causes the house to move. What they left out of their report was that there was a flood and it sat underwater for 3 days. But with a straight face, they go, oh no, it's not that. Couldn't be this flood that saturated it for 3 days underwater. It's definitely the water cooling. And it just shows there's a number of assumptions, including when they did their assessment and they look at the level of the ground underneath, they didn't factor in how had the flood impacted the level of that ground. There wasn't little areas that could pool water prior to the flood. So it's something that really frustrates me when I see it, because it seems time and time again they do that. But for consumers, you see it at AFCA, they will weigh it up. And if it's objectively not true, then they may find in your favour. So to make sure that they keep challenging that through that process.
Another point is a roof tile where they allege that there's pre-existing issues prior to the event to say that it's not event related. I mean, another example is where particularly tiled roofs where various tiles have been displaced and they've obviously come out, sent out their roofer and say that, well, no, that was actually pre-existing as opposed to being event related. And really, again, drawing an assumption, they obviously don't appreciate that there's wind gusts of over 50 Ks and arguably that could give rise to the displacement of those tiles. And again, do they have a time machine to go back to say that was that pre-existing?
Well, no, they don't. So,
I'd love to say a tile that was cracked had to be pre-existing, despite, to your point, 100-kilometre winds and a massive cyclone going through there. But it's just that consistent point of really challenging the insurer around if they're trying to do that, making sure that they're actually proving it, because otherwise you're not getting a benefit that you're otherwise entitled to, and it can be very expensive at times. We could talk for hours about those. Maybe we will at some point, but we will move on for the purposes of this podcast. The next one that naturally flows from when your property is damaged, and usually if it's significantly damaged or it's going to be a construction site, you need temporary accommodation. Talk us through that in a general sense. Under a policy, what does temporary accommodation normally cover?
yeah, so usually it's 10% of your sum insured. Depending on the insurer, it's 10% on top of the building sum insured, not inclusive. It depends on the type of case. I mean, particularly some of the matters that we see, if it is mould related, we commission mould results that do say that the place isn't safe to occupy. And that really puts us in good stead to put to the insurer that temporary accommodation is required. And in that instance, we seek a like for like temp accom arrangement. And usually that tends to be Airbnb, short stay accommodation, and they're entitled to that allowance.
Yeah, so I think you're right. The reason they call it an additional benefit is because, to your point, it's 10% of the sum insured sometimes, but as an additional benefit, not including it. They do all vary slightly. Like sometimes they'll say 12 months accommodation or 24 months accommodation. So it's one of those ones you got to read your policy and understand what it says. I think what you see through AFCA is that it needs to be practical. Some of them will try to limit it to the average weekly rental. That's as much anymore of your property. But the reason why that's actually not practical is because after a natural disaster, alternative accommodations in high demand, so therefore the cost of it goes through the roof. And also sometimes you might find, as you've touched on, if your property is mould impacted and all your contents may be impacted, or a fire and all your contents are gone, the temporary accommodation you require is actually furnished, right? So it might be an Airbnb, and they just naturally come at a higher cost. So it's really important to read your policy, to understand what you're entitled to make sure that you're communicating the requirements as well to the insurer. So if you do have young children, or you do have pets, or you do have vulnerabilities, you might be in a wheelchair and you need certain access, that when that time comes that you might need temporary accommodation, that you're communicating with the insurer and saying, these are our requirements. At that point, the insurer will sometimes arrange that for you. So they'll use one of their providers who will go out and try and find alternate accommodation on your behalf. Sometimes they can't find it, and they might say to you, we can't find a suitable property. Can you look into it? At that time, you can go look and try and find it. I always recommend to people, if you're going to go, you may as well just try and have a look yourself if you can find something suitable. So if you're trying to find an Airbnb in your location and you can see that one's available, sending that link just sometimes can speed up the process. And the insurers don't always have access to those because they have panel arrangements and they have certain amounts that they will pay. But if you do need it, you put that to the insurer and ask them to fund it. One of the challenges we see come up a lot is that people will do all of the right things. They'll look at it and go, well, half my property has been damaged in this. The repair time frame is going to take a long time. I have young children. I need to be in this location. My children need certainty as to where they're going to bed at night. Can you approve 6 months? Well, and the insurer will turn around and go, no, we're going to give you 1 week of accommodation. And they'll put them in some short-term rental. And then after that week, they go, oh, we're extending it, but that one's no longer available. And they find themselves in this constant moving from property to property, which is very disruptive and causes a lot of issues. If a customer finds themselves in that situation where they're unhappy with the alternative accommodation the insurer is providing to them, or they're getting moved around a lot, what should they be doing with the insurer?
Well, look, I'd be conveying those issues. And I think that if the particular claims handler, the insurer, isn't really seeing the broader picture, the client's needs, the vulnerabilities, and the requirements in respect of the temporary accommodation, then really I'd be making a complaint. An IDR complaint would be the first port of call. And then ultimately, like you've said before, submitting a complaint through the Australian Financial Authority is also an option. I think it's just making clear on what the requirements are and being firm on that.
Yeah, and I think, just to be clear, a complaint is just an expression of dissatisfaction. So in terms of complaining to the insurer, often they're already doing that, but it's actually making them actually record it as a complaint and ask for it to be reviewed by the internal dispute resolution team. One of the things I want to touch on is there are circumstances where there truly isn't another option available. And that could be because you live remote. Say you have a policy your home's damaged, but the next available location for temporary accommodation is an hour away and you need to feed your animals. There are other options available which you can explore with your insurer, which might be, say, a temporary home on your property. It could be a caravan on your property. But without actually sort of talking to the insurer through those options, sometimes they're completely unaware that you'd actually prefer that than living an hour away. So talking to the insurer or finding solutions that suit your family and putting it to the insurer is a really good step. What you'll often find is that the insurer will either say, the policy doesn't cover that, our process has a maximum daily limit of $100, whatever it is. At the end of the day, it's what the policy says. So what their internal process is kind of doesn't matter in that moment. So whenever you are finding that you're not getting what you think is reasonable, that's why complaining helps, because it goes to different teams with different delegations that can make decisions that a normal claims team can't make. So again, the consistent theme when it comes to complaints is just make sure you're really explicit with what you want. And also probably not to defend the insurers, but if it's not available, it's not available. Like, they can't make you a home in your exact street where your kids can live on the same street, right? Hypothetically. But if there is a property that's in close proximity that might be a little bit more expensive, they can certainly pay for that. So make sure that you've actually got the option that allows them to resolve your complaint, not just making a demand without doing your own research as to whether that's actually practical or not, because all that sort of condemns you to is a complaints process where they're likely to go, well, it's been 30 days and what would you like from us? We'd like to work with you. So do it up front, try and work out what that solution is. It may be that it's caravan, or it may be that it's some alternate solution, but it's unlikely the insurer will necessarily suggest that to you unless you go to the effort of looking into what that could look like. The last thing I wanted to cover when it comes to temporary accommodation, which people often panic about, is when they have an insufficient sum insured. So if it is 10% of your sum insured, but you've only insured your house for $300,000 and you only have $30,000 and you're in a property that's $3,000 a week, you start to get nervous really quickly that, oh my God, I'm going to exhaust this temp accom and the repairs haven't even started. I think what's important, a couple of things on that, is that if you are concerned about that you are raising it with the insurer and saying, well, I would like to be in a property where it's not as expensive so that this is going to last longer. But often I do find that insurers are quite willing to extend the allowance for temp accom because I think they acknowledge that there are some things outside of both parties' controls that naturally erode the policy benefit. And then if you are unhappy with that, again, you can complain and you can ask for additional policy benefits around temp accom, because if the insurer's actions are delaying the claim and that's causing you to just erode your policy benefit, it's not really fair to you to then have to fork out temp accom when your home is being repaired or when you're actually repairing your home. So the limits are there, but insurers are pretty pragmatic, and AFCA is pretty pragmatic around if those policy benefits aren't necessarily eroded. So just make sure you're raising that with the insurer. And if they are saying, oh, it's been eroded and we're not paying you anything else, maybe it's time to complain, as we've discussed multiple times. All right, let's move on to contents cover. So it is often an additional thing that you need to take out from your insurer. It's not just included automatically when you take out a home policy, because it's a home and contents policy. So when it comes to contents cover, what contents is the reverse of the analogy I said before with the home. If you turn it upside down and you shook it, everything that falls out of the house is considered contents. Some of the unusual things that are contents, which you may not immediately think of, is in most domestic insurance policies, the carpet, for example, is part of your contents sum insured. The same thing arises around the sum insured and whether you have a sufficient sum insured for contents. A lot of people find out at the time they don't have a sufficient sum insured because it's new for old. So if you had an old phone that was destroyed in the flood, then it's replaced with a new phone. So it can very quickly be eroded. In terms of if you have a contents insurance claim, what is often some of the evidence you'd need to show an insurer show that the contents is damaged?
Yeah, look, he'll usually send out an assessor to determine whether any particular items are affected from that particular event. And then ultimately, if they determine that the contents items are non-restorable, so that typically means that it's either porous or semi-porous items in most of the mold claims that we see, then ultimately they will determine the replacement item of that. And then ultimately they'll determine the replacement cost for all those non-restorable items.
And one of the common things that they'll either get themselves or you might produce is the contents inventory, which is simply a list of the item, the damage, and the replacement cost. In our template, we also have a link to it so that if you're saying this TD is from Harvey Norman and it costs $1,500, it makes it really easy for the insurer to then validate that that is true. What you've touched on there around mold claims, for example, is sometimes you do need another expert to comment on it and say, yes, we can't repair that, or we can't replace that item, and therefore it needs to be cash settled by the insurer. So when it comes to contents claims, they're pretty much always cash settled. They don't go out and buy you new TVs and things. You'll get a lump sum payment for that. If it is over the sum insured, and say it's a flood, goes through your house, all your contents are lost, and you only have $30,000 in contents, unfortunately, it is a hard limit when it comes to your contents sum insured, and you get to set that at the start of a policy. Unfortunately, you don't think that hard about it until the claim happens. But if the event itself exhausts the sum insured for contents, then that is all you're entitled to. The only real exception to that is if you can show that the insurer's conduct or their provider's conduct actually resulted in increased damage to your contents. So if it is a mold example, they didn't do anything, they let your house rot for 6 months, and suddenly all of your contents are damaged, and when the event first happened, very little of your contents were damaged, then you can still go to AFCA and say, well, the insurer's conduct actually resulted in increased damage above the sum insured, but you would still need to be doing those same processes of documenting for AFCA to show, well, here are the contents, here's photos, receipts of the contents that I had, and this is why they were damaged by the event. I think what's important when you have a big event, like a flood or a fire, that you also take photos of the contents that were damaged, and that you give the insurer an opportunity to assess it. As you've said, sometimes when you're just after a natural disaster, you're stressed and you're going through emotions, you can just sometimes throw them out, but the insurer can raise some issues if that occurs. So just make sure that you are notifying them. If you are going to throw out contents, look, I'm going to throw these contents out. These are why. Do you want to view them? Do you want to see them? The photos, videos enough? Make sure that's on recorded alarm or in writing, so that when they respond and say, yes, you can throw them out, you have that later on if an issue arises. All right, we're going to fly through some additional benefits that people can get. So again, not all policies have this, which is why it's really important that you have a look at the additional benefits on this. George, what's your favourite additional benefit that people might have?
My favourite is pet temporary accommodation.
Is it?
It's like, yeah, I haven't come across that in a particular case. I know that one is in there. I think there was a hole-in-one. We're not going to put that in there, but
No, we would have.
we won't mention the insurer, but there was a hole-in-one.
Yeah, I think one of the Chubb insurance policies has an additional benefit for a hole-in-one. If you get a hole-in-one in a competition, you get $1,000 or something like that. So it doesn't necessarily mean the additional benefits relate to the same at all, apparently, but most of them do.
But no, look, just circling back, I think that it's quite common for debris removal to be an additional policy benefit. So if there's particularly remediation, a lot of materials have to be removed. So that would give rise to capturing the additional policy benefit for debris removal.
And that's a good one if you find that you are going over your sum insured for property damage, because you can start to split out that, well, that part of it relates to debris removal and the rest of it relates to reinstatement of the building. That can help, because you might then get enough to pay for the full amount of damage at that point. All right, some of the other ones which are reasonably self-explanatory, but a lot of policies will cover spoiled food due to power outages, for example. So if you have a fridge full of food, George, or your protein shakes, for example, that you've got pre-made, ready to go, if you lose power, you can technically put in a claim for that food being spoiled, and there's usually a pretty modest allowance for that, for $500 or something like that, depending on the policy. Very few policies cover landscaping, but some do. If they do, it is a additional allowance. So people also just assume, if we've had landslides that go onto people's property and you're like, well, all this dirt has ended up on my property, surely the insurer will just take it away. But the reality is some don't include earth moving, and the landscaping might be as little as $2,000, which doesn't really go far, particularly after a flood. It's something that is reasonably straightforward if you have it and the damage aligns with that. Replacement of locks is a good one. So if you get broken into or some issue occurs, you can get the replacement of locks covered. Obviously, locksmiths are not cheap. There are also cover for solar panels, for example. So not all policies cover solar panels. So if you have a policy, make sure you've told the insurer that you have solar panels. A lot of them will just immediately add that. Same with a battery, for example. If you've added that to your home, make sure that you're advising the insurer of those items. Motor burnout. So when it comes to air conditioners, some policies will cover if your air conditioner burns out, if you're an electrical burnout. So if your aircon dies, it's worth getting an electrician over just to understand what has happened to that. If it has burnt out, then it can be covered under the insurance policy. If you have a landlord policy, you do also have an entitlement sometimes to loss of rent. So if you do have tenants and you have a fire and they need to move out, cover loss of rent for that period. The other one that you see is professional fees in the context of usually total losses, where they will cover things like engineers' fees or lawyers' fees if you need to discharge your mortgage. So it's really important that when you have one of these, that you look at your policy and you look at what you are covered for. The other one is like super important to identify if you have it is called a safety net, which some insurance policies will have what they call like a 25% safety net. And that means if your sum insured is exhausted, they will pay an extra 25% above the sum insured. So if you had $1 million, that could be an extra $250,000. So your sum insured then is technically still $1 million, but you do have up to 1.25. And after the floods in Brisbane, the insurers that did cover that came up a lot, and that can really save you in those circumstances. The other one from a contents perspective, which we touched on, it's also really important if you do have listed contents items, because a lot of contents policies will not cover all your Rolex watches, George. So if you do have, how many you got, George? 10 of them? You got to go and tell your insurer every one of those 10 watches and put a value on it. Or that engagement ring you just bought, George, for your partner that you haven't proposed yet.
No.
You'd have to list that as soon as you got it. Don't tell her.
Don't just waiting on a few.
Wait for her to find out. Wait for her to find out. Oh, darling, you've
Yeah, I told you she'll get through halfway the meeting and go, no, she'll say no. Anyways.
Just to be clear, George, there's not time that he's bought an engagement ring, so your partner's lovely, so maybe you should. All right, so we are going to quickly cover off the benefits that are not necessarily in a policy, but you might be able to claim. These can be a little bit tricky, but with the knowledge increasing across the board with things like AI and groups and things that we'll reference in our notes for this podcast, there are benefits that you can claim when you go through the AFCA process, which may not necessarily be in your policy. Those are things like contingencies, interests, non-financial loss, financial losses, and professional fees. We'll go through those individually. Then we can talk about, I guess, some of the challenges that might arise with those claims. But what customers need to realize is that when you first request it, the insurer is 100% going to say to you, that's not covered under the policy, so therefore you're not entitled to it. But that's not necessarily true. So when we talk about other benefits, there are a few that come to mind that come up quite regularly. Those are things like contingencies, interest, non-financial loss, financial losses, or professional fees. I'm going to fire through them one after the other, and you jump in at any point if you want to add something. So when we talk about contingencies, this is something that's really become quite popular after the floods. It's what AFCA look at, which is it takes into account, well, if you have a quote, it's often a point in time, and it's their best guess at that time what the cost of repairs is going to be. So AFCA sort of acknowledge that there can be variances and there can be changes, or there could be damage that might be discovered through that process, which may increase the cost. The other aspect is if the insurer is doing the repairs, you get a lifetime guarantee on repairs. If the customer is then doing the repairs, that lifetime guarantee is lost. And therefore the customer takes on the risk of, potential future issues that may arise in the repair process or in the repairs themselves. So AFCA tends to award usually somewhere between 5 to 20%, depending on those factors and depending on, on a specific case, what does that look like? If you have a very simple claim and you have an up-to-date quote, it may be a very small contingency. If you have a very complex claim that involves mould and it involves where you haven't necessarily stripped the walls out and a whole heap of things could happen, or an old property where once you start taking walls off, who knows what you're going to find. That's where maybe a higher contingency may be reasonable in the circumstances. It's important that it's not a policy benefit. So when the insurer says, but we don't have a policy benefit for contingencies, that is technically probably correct. But equally, it's the fair thing for them to do. So if you do push it to AFCA, AFCA will look at contingencies and they will make that allowance. So if the insurer is saying we don't know a policy benefit for contingencies, say, thank you very much, I would like to make a complaint, and then I will also be going to AFCA. And then just try to be reasonable in that process. Not trying to claim 100% on top of your quotes. The whole point of it is that you should have an actionable quote, which means a quote that you could get the repairs done for. That is ultimately what AFCA is trying to look for to work out what that is. You can claim contingencies on the insurer's quotes, and you can technically claim them on your own quotes, but the same principle applies. Obviously, if it's the insurer's quotes and you can see that things are missing, or you can see the rates are really low, it may mean that your contingency is higher. I would always recommend getting your own quotes for that. Interest is pretty straightforward. It means if you had an entitlement under the policy that became payable and there has been any delay in that process to making that payment, you can claim interest from the insurer. So that interest is payable under the Insurance Contracts Act. So again, they'll say it's not under the policy, and you'll say, it's That's under the Insurance Contracts Act. The most common example where that occurs is where they decline a claim inappropriately and later overturn that decision and then pay the claim. You're entitled to interest for the period and it became unreasonable for them to pay that claim. So on that point, it doesn't necessarily require them to decline the claim. It just requires there to be an extended delay around that. The other one is non-financial loss. Bit of a strange term, to be fair. What that really means is kind of compensation for inconvenience that AFCA can award under their rules. And what they're really looking at is they appreciate that for a consumer that has an insurance claim, there's a normal level of inconvenience that happens. So just because you need to move out of your house doesn't mean that insurers contributed to that. What they're trying to look at is, well, what is the level of inconvenience that this person has experienced that was unreasonable on a claim because of the insurer's conduct? And they can award it up to $6,300. That does change each year and increase slightly. It's really quite a conservative allowance the way AFCA approaches this. So I would love it to be $100,000 because then you might make insurers actually change their ways. But it often means that if they have mishandled the claim, the person has experienced inconvenience, then AFCA will make an allowance for non-financial loss. But you can also request that from the insurer if you think there's an amount that is reasonable in that process. What's something, George, that they could do that causes unreasonable inconvenience?
Well, look, I mean, before matters come through our doors, we tend to see that non-financial loss is quite strong. Ultimately, we tend to get our clients to draft up a witness statement, just really outlining the effects that this claim's had on them, particularly their personal life, family life, and I mean, even the health effects that might be associated with the claim. And it really just hones in on that inconvenience, the effects that this has had to support our claim for non-financial loss. So I think that having clear documentation, if there's any medical effects that might be associated with the claim, that really supports the claim for a non-financial loss basis.
Yeah, I think that's right. And an example could be where they made you move 15 times. They could have just proved the longer one you're asking, you hadn't moved 15 times, kids had disrupted schooling. And to your point, a statement is a really good way to demonstrate what that is. The next one is around financial losses. So not something you see very often in AFCA complaint determinations, but in their recent guidance around claims handling, they spoke about financial losses, which is the financial losses that directly relate to the insurer's mismanagement of the claim or their conduct. So if you can point to where their conduct has caused actual financial loss to you, you could technically put forward a claim for that. And what is a really good example of that is like out of policy benefits. So you know when we talk about sum insured and we say, oh, I had a $30,000 content sum insured, but I now have $100,000 worth of contents damage because their restorers put all my furniture out on the lawn. It got rained on and they left it for 3 weeks and they're now all destroyed and it's worth $100,000. And what you're saying is that your financial loss is technically the $70,000. So it's the difference between $100,000 and the sum insured limit, because it would be unfair in that circumstance to limit it to the $30,000 when the insurer's providers actually contributed to the $100,000 loss. AFCA is pretty conservative in doing that, so you would then need to have really good evidence to establish that, but for the insurer's conduct, you wouldn't have incurred those financial costs. Where it falls down sometimes is where you may be incurring that cost anyway. For example, if you're attending counselling every week, but the claim has caused increased stress and inconvenience to you, and you talk about that with your counsellor, because you were incurring that once a week, you hadn't necessarily incurred a financial loss in that. However, it's important to note on that point that you can always ask the insurer to cover that as an additional benefit if you would like. The final one is professional fees. So under the AFCA rules, they can award professional fees. 2 examples for professional fees are like expert reports. So if you were going out and obtaining independent quotes or engineering reports and that's coming at a cost to you, you can claim professional fees back from the insurer. The limit from AFCA is $5,000. I think there is a recognition that it doesn't actually take that much to get for the $5,000 sometimes. If you've got an engineer and a mould specialist, then you're over $5,000 pretty quickly. But assuming you can show that the report was required and it was reasonable for you to obtain that report and those costs were reasonably incurred, AFCA will often award the cost of those reports. Most insurers are also quite good at making that allowance if you can show that it actually contributed to the resolution of the claim. However, again, they will tell you that's not covered under the policy because it's not, but you are entitled to claim that back. And then the other one is that you are sometimes entitled to claim, say, advocacy fees or legal fees if you incurred those. Again, current limit AFCA is $5,000, so it's not a lot of money, but you would also need to show that the insurer's conduct required you to get that advocacy or required that legal advice or assistance in that process. So again, obviously, statement, a timeline showing, that you were trying yourself to resolve it, they weren't engaging with you reasonably, then you got someone involved and it helped resolve the claim, then AFCA may award an allowance for professional fees. It is important to note with all of those sort of allowances that AFCA is quite conservative in their awards. It's also often quite unclear what amounts they're going to get. So when it comes to a contingency, it might be 5 or it might be 20%. What that probably means is that you need to be reasonable if you are negotiating with an insurer, you're working through that. But also you can involve AFCA and have those conversations with AFCA and the insurer to try and resolve it. Obviously, if you do have an advocate involved, they can help prepare the evidence to support making those claims and allowances. But if you are not getting those allowances and you're asking for them, then complaining is the best method to try and get those allowances made from the insurer. We do find, unfortunately, and it is something that I raise with these insurers, that it is frustrating that sometimes you actually have to lodge the AFCA complaint, which takes 10 minutes. Once you're in the AFCA process, then suddenly the insurer is willing to make those allowances where if they're being fair and reasonable, they probably should have done it prior to that point. One of the things that we would say is if you have a property damage claim, you really need to focus your energy on making sure that that is really documented well and evidence-based, and that you can really justify enough here that the allowance you're requesting for that is appropriate, because that is often the largest sum. So some people can get a little bit distracted by these other benefits and put a lot of time and effort into that, but they forget to justify the main thing, which is the actual policy benefits under the claim. So I would say to people, make sure that you're understanding the benefits that you do actually have, making sure that you're meeting those evidence requirements, and then you shouldn't have issue through that process. George, your final thought when it comes to policy benefits, or your final tip to leave people on, what would you recommend?
I would double check your sum insured and in turn your contents. I think it's quite a common theme for clients to always underinsure their contents. They don't really appreciate the value of their items. Particularly, they fail to specify high value items. So that's very important. And then in turn with the property, have it valued. Ensure that you have an appropriate building sum insured, because arguably tomorrow's not guaranteed. If there is an event and you is significantly underinsured, then really you're captured by that. And we see it time and time again in this sort of space.
If you had insurance on any everything, you wouldn't have to carry around all the time. Would you, George? Final piece of advice for them would be that if you do have a claim, make sure you read the policy and your insurance certificate and understand what benefits are applicable to you, because the insurer will not proactively necessarily tell you what you're entitled to. And then if you can go informed from the start, so as soon as the event happens, you're going to be far better placed to try to work this out after 12 months. George, thank you for your time. That is right.